Good afternoon, everyone. We will get started with today's webinar in a moment. I'm going to give our audience a moment to get into the actual webinar. Mike, Joel, Malgosia, how are we doing today?
Great.
Good.
How
How
are
are
you,
you?
Allison?
Doing well. Excited to listen to this. I can tell everyone from our prep session, there's a lot of content today, and I'm very excited to go through all of it. So I see that we are getting into a minute past the webinar start time. So I'm going to jump right into housekeeping items, and then we'll have our panel introduce themselves. Welcome, everyone. Today's webinar topic is Welcome to the Risk Era, Insurance Solutions That Actually Work, presented by Proctor Loan Protector. Now, before we dive into today's content, I have a few housekeeping notes. This is meant to be an interactive webinar. We have a poll question for you in the beginning of the webinar, a poll question for you at the end of the webinar, and we will be taking audience questions at the end of the webinar. You can submit questions for the panel at any point in time by using the chat or by using the Q&A icon at the bottom of your screen. And if you miss anything or want to revisit any part of today's conversation, you will be able to do so by rewatching the recording, which we will release later this week. So with that, today we are joined by a panel of industry experts. Joel, let's start with you.
Hi, everybody. Joel Sulkis. I am a senior managing director at Brown & Brown, and I have been in the insurance industry in one form or the other for 30 years now.
I'll go next then. Mike Demas, Proctor Loan Protector. I am one of the senior vice presidents of sales here. I've been with the company now 19 years. I guess important point to note is Proctor Loan Protector is a wholly owned subsidiary of Brown & Brown, which works very nice when we talk about this kind of holistic view of insurance coverages and requirements for the FI space. So want to make note of that. Thank you for having us, Allison.
Hey everyone, my name is Mgosha Stella. I am the Senior Vice President of Compliance at Proctor Loan Protector, and I've been with Proctor about 14 years, and before that, I was an attorney that specialized in banking and insurance.
Thank you all for introducing yourselves. Now we are going to jump into a quick little audience poll. So you are going to see a poll question jump up onto your screen. Within your current role, what is your biggest concern when it comes to insurance issues for your institution? Is it cyber insurance, coverage availability, environmental risks, or regulatory compliance and audit, or is it something else entirely? Let us know what is your biggest concern when it comes to insurance issues for your institution. All right. We have some polls coming in. I'm curious if anyone has any predictions. Mike, do you think it's going to go one way or another?
It's always a coin toss depending on who all was able to join. Cyber's always at the top of the list, and then you got regulatory, which is everyone sitting on everyone's shoulders constantly. So it was kind of interesting when we were thinking about doing this. What's relevant information we wanted a feedback loop on, and so it'll be interesting to get the results.
Okay, well, I have a little plot twist for you.
Uh,
So it looks like the biggest response was coverage availability. And the second most popular response was regulatory compliance and audit.
so I was half right.
Half right, half right. All right. With that, I think we are ready to jump into today's content. So I'm going to pass things over to Joel.
Great. Thank you, Allison. Really great to be here, everybody. So just a little bit of a background on Brown & Brown. Got some of our stats up here. Brown & Brown is now the sixth, actually maybe the fifth largest insurance broker in the country. We just went through our largest acquisition over the summer of Ascension Risk Strategy. So some of these metrics are actually a little bit outdated, but by and large, we place close to $50 billion now between the two organizations of insurance into the market. And we've got 35,000 employees now globally, up from 17,000. So we're a big broker. What I would say is in the part of the firm that I sit in, the retail part, we represent our clients in the insurance markets. We advocate for them in the insurance markets. We do not represent the insurance companies. And I lead the FI practice at Brown and Brown, comprised of our banking, our asset management, our insurance company, our reinsurance company, our fintech clients. And as we just said earlier, work very closely with our colleagues at Proctor Loan Protector, Mike and Malgosia, to serve our financial institution and our banking clients. We're really excited to be participating in this event. Our understanding is that the audience today is comprised of some banks and some non-bank lenders. And within those institutions, there may be some of you that are focused on or have an interest in the enterprise risk of your institutions, along with those of you that are customer facing, maybe portfolio managers, loan officers, salespeople, thinking about the customers of your institutions that you lend to on real estate assets. And so, what I would say to sort of frame the discussion is that I would preface by saying two things. The first is that the insurance markets are not a monolith. And the corollary to that is that different parts of the insurance markets are constantly going through their own idiosyncratic profitability cycle. So in terms of the poll that we just had, coverage availability, the interest in coverage availability will be really something we focus on and talk about throughout this discussion as we cover off on the various different insurance markets. And so, our goal today is to give you all a better sense of some of the more relevant markets that bear on banks and lenders and where those insurance markets currently are in their profitability cycle, so that you have that context when either thinking about your firm's enterprise risk or when you're working with your lending customers. So first off, the insurance markets are not a monolith. There are different pools of capital, different markets for different risks, different sectors, and different products. And as we think about risks facing banks, non-bank lenders, other types of financial institutions, we can just break these up across enterprise risks and lending and counterparty risks. And so, if you're thinking about the enterprise or the operational risk of the institutions for which you work, there are a number of very robust insurance markets. There are insurance markets that can help your institutions hedge or manage your litigation risks. So think about security class actions against your board of directors or your management. Think about customers suing your institutions for failing to live up to the delivery of financial services as promised, as advertised. Think about employees suing your institutions for discrimination or unfair treatment. Fraud is another massive operational or enterprise risk committed either by insiders of your institutions or external bad actors. Each of your institutions has a corporate footprint and so therefore is exposed to physical risk of loss, physical damage. Think about your offices, your data centers, your disaster recovery sites for certain larger institutions, and the follow-on potential business interruption or P&L impact. And then lastly, cyber technology risk is just another really large operational risk domain that can encompass a spectrum of risks. Think network security breaches, think privacy losses, data leakage, system failures or platform failures, the follow-on business interruption, and again, customer litigation if your institution is actually provisioning technology services to your customers. And then on the right side of the screen, counterparty or lending risk. The risk of non-payment or credit risk, the risk of default. There are risks surrounding compliance and servicing risk for servicers. There's a minefield of regulatory state GSE requirements imposed on communicating with and servicing loans with your borrowers. Malgosia and Mike are going to talk quite a bit about this. And then there's hazard risk on loan collateral. So think physical risk to the loan collateral from catastrophes, et cetera, that bear on your institution's credit risk profile. And so when we talk about the state of the insurance markets and we think about the availability of coverage, it's really important that we frame this from these vantage points, and are thinking about this across the relevant products and solutions, and those relevant market dynamics. So the second sort of lever, in terms of framing the discussion, is that insurance markets, these different insurance markets, go through their own idiosyncratic profitability and underwriting cycles. And so what I'm really talking about here is the flow of capital into and out of the insurance markets and the profitability of these different insurance markets. And so from a profitability standpoint, insurers really only have two levers to pull to be profitable. On the one hand, they can make money from the premiums they charge for their products on the liability side of their balance sheet. So are they good at what they're supposed to be doing? Are they good at underwriting risk? Do they have good loss ratios? And then secondly, they can make money from how they invest and put those premiums to work on the asset side of their balance sheet, or as Warren Buffett would call the float. So on the liability side of an insurer's balance sheet, there are macro variables that impact underwriting profitability, such as the impact climate is having on our planet in the form of physical risks, such as hurricanes, flooding, drought, wildfires, these acute versus these chronic risks, which we will be talking plenty about during the course of the discussion. Geopolitical events are other factors that impact product offerings and corporate strategy for insurers. Social inflation increases the cost of litigation. So our tort system, legal system abuse, inflation around medical costs, all of this bears on insurer and underwriting profitability. And then on the asset side of the balance sheet, interest rates and inflation impact profitability and the flow of risk capital into the insurance sector. So in a low interest rate environment, for example, we tend to see more capital coming into the insurance sector in that sort of classic search for yield. And the opposite tends to be true in higher interest rate environments, where we see capital less quick to move into the insurance sector versus into other asset classes. And so in any particular product line, in any particular insurance market, there is this constant tension, this constant push and pull. Investors look to time their investment into the insurance industry when factors are favorable, when there is underwriting discipline and insurers are making an underwriting profit, or when interest rates are low and the range of yielding opportunities is more limited. That entrance of new risk capital inevitably results in overcompetition, a lack of underwriting discipline, or a softening of the insurance markets in question until the next macro event changes the profitability dynamics, resulting in a harder market and the entrance of new risk capital, and potentially new classes of insurance risk capital. And so as we go through the discussion today, these will be some of the underlying concepts that you'll see as we overview the state of the various insurance markets that are generally of the most interest to banks, lenders, and other financial institutions. And so we will start with the commercial property insurance market to sort of set the stage here. And this is what people tend to read about in the papers. This is kind of headline risk. It's not exactly the homeowners market, but there are definitely corollaries. This is the insurance market for commercial real estate assets. And so, you can really see here on this slide, I think it spells it out pretty clearly, the steady build of increasing losses from catastrophes over the last 7 to 8 years, really starting back in 2017. So here with Harvey, Irma, and Maria, and various wildfires in California, which generated at that point $100 billion in losses to the commercial property insurance markets in 2017 alone. In 2018, we saw more large-scale hurricanes in Florence and Michael in the Southeast hitting Florida and the Carolinas, and we saw more wildfires in California. And so the market, again, in 2018, took on another $25 billion in losses, catastrophe losses. The pandemic came around in 2020 and added $40 billion in additional catastrophe losses to the insurance, commercial insurance markets. Things like event cancellation insurance and business interruption claims from lockdowns globally, along with civil unrest claims. And then really after that, the tipping point for the commercial property market was in 2022 with Hurricane Ian off the Florida Gulf Coast. You might remember Hurricane Ian. This was a $60 billion singular event to the market at a time when inflationary factors post-pandemic were really driving up property values and claim costs. And so, this was really, the perfect storm, really, no pun intended there, hitting the commercial property market, which ultimately drove a much needed massive correction. And so post Ian, in 2022, everything I just described happened. Massive amounts of losses off of a series of catastrophes, inflation creating the cost to make repairs to properties go up, increasing the demand for insurance. Interest rates were also now up, forcing insurers to mark down the bonds on their balance sheet, therefore shrinking the size of insurers and decreasing supply. And so all of this led to a massive supply-demand imbalance, with demand outstripping supply, that drove this massive rate correction and a 6 to 7 month corrective and extreme hard market for all property risks, regardless of whether you had losses or were even catastrophe exposed. The rule of thumb was double, double, half. So insurers were doubling retentions, doubling prices, and having limits, halving limits. And so ultimately, it was that medicine that drove rate growth up by over 200%. And this did the trick. This ultimately corrected for these years of outside catastrophe and attritional losses in an underpriced market. And so, following this, classically, after about 7 months of this extreme hard market, what did we start to see? We started to see capital, in this particular case, from within the insurance and reinsurance industry, chase yield and reallocate itself over to the property markets, away from other lines of coverage, to stabilize the market. We didn't see new classes of insurance capital or new insurers necessarily form in this time period, but we did see a massive reallocation of capital from within the industry to the property markets. And so over the course of 2024, even with Hurricanes Helene and Milton at the end of 2024 generating sizable losses, we saw after a 7 month hard market that the market was starting to lose discipline. The market was starting to become competitive again and was bordering on profitability. And so, now in 2025, when we think about the commercial property market, we're looking at a market that has completely digested Hurricanes Helene and Milton at the end of 2024. Most insurers, just as a side note, really didn't even receive reinsurance proceeds or have any impact to their earnings from those two big events. We're now halfway through 2025, and the industry year to date has already sustained $80 to $100 billion of losses, which, by the way, is sort of the highest level of losses heading into a hurricane season. So, earlier in the year, we had the LA wildfires, we've had tornado outbreaks, we've had severe convective storms, more of which we'll talk about. And so the industry has already, halfway through this year, sustained quite a bit of losses, but none of this is yet impacting availability. We've gone through our 2 reinsurance treaty renewals over the course of the year. They were uneventful. The expectation is honestly that the commercial property market could now sort of sustain $150 billion in annual losses without impacting insurer profitability. And so with all of this going on, that correction that we talked about that happened on the back of Hurricane Ian is still holding. I think all eyes are on the balance of the year and the balance of hurricane season. But as of right now, it's a pretty competitive buyer's market for commercial property insurance. And so I think this sets the stage for what many of you may be interested in, which is the lender-placed insurance markets. This is the area where we are really seeing a large uptick of interest due to the challenging homeowners insurance market and the lack of availability or the lack of adequate limits. And so to frame this, this is the part of the discussion that's directly on point in terms of how this group should think about protecting your institution's balance sheets as the lender-placed markets provide contingent coverage and servicing solutions to your institutions with regard to the collateral supporting your commercial and your residential lending. And so with that, I will pass it over to Mike.
Thank you, Joel. It's always interesting when you get into insurance and we've got such a array of different folks within different FI practices that are interested in it. But as Joel mentioned, lender-placed insurance has become a hotter topic, especially over the last couple of years for many reasons. One, the regulatory piece, which Malgosia will talk to shortly, but just the availability and access to coverage, as Joel just mentioned. What I thought would be good, just kind of start with that high level. What is lender-placed insurance? So think of it when a lender makes a loan, they have three requirements: pay your mortgage, pay your taxes, pay your insurance. And sometimes you do that in one payment to your mortgage servicer. As part of that responsibility and part of the guidelines is to track and monitor that all of the insurance policies on each of the loans is in good standing. So A, is there coverage? And B, is there enough coverage? So flood, primarily more on that side. And there's three traditional coverages within that: your hazard insurance, which is your homeowners, flood insurance, and your REO. REO, for those who don't know, it's when a lender takes a property back through foreclosure. So those are the kind of the three main principles. So Joel, if we want to go to the next slide, we'll talk about when and identifying an issue that leads to lender place. You see my first box, we have the pre-expiration. So to us, that is the work that goes into trying to procure or find the policy that we need to pay on in the coming 30 days or so. So Jane Smith's policy is coming up in 30 days. We don't have a renewal policy or we don't have an invoice to pay on. Our job is to find that through many methods that we have on our side. So regardless if you're outsourcing your insurance tracking or managing it internally, the process is the same. So you're looking for policies to pay on. Usually, obviously, that's when there's an escrowed situation. If it's not escrowed, that's the responsibility of the homeowner. Second is we leverage a bunch of tools and data to try to obtain the insurance policy. So whether it's electronic information, APIs into carriers, whatever it may be, agents, carriers, using all the tools available to us where we can try to track down that policy before we have to notify a homeowner. As part of the regs, once that policy expires and we don't have a new invoice or a new policy to pay, we must make notice to the homeowner. That's done via letters. It can be done through other methods, but by law, we must send a certain amount of letters in a time frame that's reasonable. At the end of that process, if they've still not complied and provided us new insurance, we must place lender-placed. You might hear it called force-placed. They mean the same. That protects the asset for both the lender and then any of the equity or money bought down on by the homeowner. So traditionally, you're looking for that replacement cost coverage. So in the event of a loss, when the homeowner didn't provide their own coverage, everybody's protected because we have now stepped in and provided this coverage. What's important to note here, this isn't a like-for-like coverage from a homeowner's policy, meaning we don't cover contents, we don't cover liability, it's the structure itself. So while the coverage isn't as adequate or full as a traditional homeowner's or voluntary homeowner's policy, we're still meeting the requirements. But what's important here is that we are protecting both the lender, the homeowner, but also then if they've sold the loan, if it's a government GSE loan, there's some requirements that support that. So there's a little bit of background there. Before I go on, I thought I'd pass it to Malgosia to jump into some of the regulatory content and pieces of this. So Malgosia.
Great. Thanks, Mike. Hello, everyone. So my name is Malgosia Stella, and I am the Senior Vice President of Compliance. So today I'm going to be providing just a brief update of where we are with the regulatory landscape and the compliance landscape as it relates to lender-placed insurance and some insurance requirements in general. So just for a little bit of a background, I'm going to start with the regulatory framework. The CFPB was tasked with the obligation by the Dodd-Frank Act to develop the RESPA rules, which it did. So for the past 12 or so years, maybe more at this point. The CFPB has been the entity that all financial institutions received their guidance from with respect to RESPA, which, as Mike mentioned, there are very specific rules that are provided by RESPA that include the content, the timing of notifications, when a lender-placed insurance is considered reasonable, and refunds must be issued. So the CFPB was the regulator everyone feared for a very long time, and that was partly due to the fact that it had what it seemed like unlimited staffing and unlimited resources. Well, if we were doing this about a year ago, I would say that was the case, but there's been a significant change in the structure and in the operation of the CFPB in the past 9 months. So to start with, there's been an announced shift of priorities. The CFPB announced that it's going to shift its focus from purely technical violations to now more focused on actual and tangible consumer harm. So they want to make borrowers whole. They want to make consumers whole, rather than just dole out penalties because as a punishment to lenders. Additionally, there was a shift in the number of exams that were going to occur or that have occurred in last year. The CFPB has done about 50% less exams this year over past year. So it's a significant shift in priorities, significant shift in activities of the CFPB. Now, a lot of that comes from the new administration's effort to curtail the power of the CFPB. And then in January of 25, there was an announcement by the new administration that they were going to cut the CFPB staff from about 1,700 people to about 200 people, which represents a 90% decrease in the amount of staff and number of staff. And of course, there was a legal challenge. So you might have been hearing in the news about what was going on with that. But just recently, in fact, about a month ago, the DC Circuit Court of Appeals overruled the lower court ruling, which the lower court said the CFPB is not allowed to fire all these individuals. The DC Circuit Court of Appeals actually reversed that. And unless that decision is appealed or there's a petition for rehearing filed by the plaintiffs, the CFPB is going to be free to eliminate about 90% of its staff, which is significant. So then additionally to that, the One Big Beautiful Bill Act cut the CFPB funding about 43%, which again is huge. I mean, even without the initial mandate to reduce staff, the funding cut of 43% is quite a significant blow to the CFPB, making it much weaker than it was just a year ago. So as we see the CFPB take a step back a little bit, it's one of those situations where I think everybody is realizing that we might have been a little bit more careful what we wished for, because we see a greater surge of oversight come from the state level. We have seen many more audits and legislative actions come out of the states, and that includes attorney generals and banking departments. We see laws being proposed in states such as New York, California, Massachusetts, Illinois, and others among those that are also adopting what were considered traditional CFPB mandates that included UDAP. So the unfair, deceptive acts and practices, states are actually adopting that as part, or they're trying to, at least they're proposing to adopt that as part of their laws, which means that state departments and the banking departments, attorney generals are going to be enforcing those much more than they were in the past. It's almost like we're going back to before the CFPB was in power, where states were much more active. In addition to that, there is a coordinated supervision trend right now. So what that means is that we have a group called the Conference of State Bank Supervisors, or CSBS. They launched what is known as the One Company, One Exam rule, or the initiative, in 2024. And it's been brewing for a little while, but it's really started to take a little bit more of a center stage in the last year. And the goal of the One Company, One Exam is to streamline multi-state exams and to build a platform. In fact, they have developed a platform where states can go in and join resources, share information. So if states want to coordinate their exams, they can certainly do that through this One Company, One Exam, which again means, more money for states to audit and more data sharing, which is lending, it's going to be more complex for servicers. Right now, I believe the focus is on servicers that are operating in 10 or more states, but again, that's just for the current status. So I also wanted to move on to flood now, because I feel like when you talk about insurance compliance, you can't talk about flood. So flood insurance has always been a big topic for the past, goodness, can't even remember how many years, probably 40, 50 years. And the Flood Disaster Protection Act, just for a little bit of background, that's the law that requires lenders to ensure that borrowers maintain the appropriate amount of flood insurance coverage when they make a loan, a federally designated loan, and they are located in a flood zone. And we see, of course, a lot of audits on this, and those audits come from a lot of different federal regulators. The issue we're having with the flood insurance Act in general, I guess, other than just audits and just maintaining compliance, is that in the past, gosh, since 2017, we have seen 33 short-term extensions, which of course causes some instability in the system. So there's always the fear that the program is the authorization is going to expire, which it's actually about to expire on September 30th. If I believe there's a vote going on today. And if we don't get an extension, again, probably another short-term extension, the program is going to expire, which leaves a lot of lenders in limbo. And there's always the fear that if the program is not extended, there's going to be a lapse. And then once it does get reinstated, which, at some point it would be, hopefully it does go back to the date of the lapse, because it creates all sorts of organizational nightmares for lenders when they try to then comply with loans that were already made during that time and borrowers who are in flood zones. So the other issue I want to reference regarding flood is because of the recent resurgence of insurance as being a really important topic. And again, that's due to environmental factors, a lot of the big losses that occurred in the last few years. A lot of questions have come up on whether the NFIP, which is the National Flood Insurance Program, whether it actually provides enough coverage or whether lenders are requiring enough coverage. Because as you probably know, the requirement is the lesser of the three, the lesser of unpaid principal balance, replacement cost, or the NFIP max, which it's currently $250,000. And with the cost of rebuilding, the cost of claims rising so dramatically, the minimum purchase requirement doesn't even come close to requiring what's going to be required to build the property. So the question comes then, can lenders require more? And technically, yes. So the federal regulator said, yes, lenders can absolutely require more. However, it's not very common right now. So, it would be more of an unusual side if lenders did require more than the minimum. But additionally, there are at least 2 states right now that specifically prohibit lenders from requiring more than the unpaid principal balance. And those states are New York, which just recently passed legislation this year, and Massachusetts, which has been around for quite a while. But those 2 states have determined that they do not want their borrowers to be mandated to carry more flood insurance, even though it actually protects their interest in the property. So that's kind of where we are with flood. And I also want to mention Fannie and Freddie, the GSEs, right? They have really had insurance under a microscope in the last, I would say, 1.5 to 2 years. And again, this is partly due to the fact that we've had such significant losses and huge weather events. So the GSEs have updated the rules and have even updated the way they're interpreting the rules, even though maybe technically the Servicing Act didn't quite change. They're now really focused on how a lender or a mortgage servicer confirms that the borrower is maintaining the appropriate amount of coverage. And to do that, the lender and servicer are required to confirm what the replacement cost is, or that the policy provides replacement cost adjustment. And of course, that's, there's a whole bunch of issues with that. In the origination side, of course, you have much more ability to require documentation and to set the stage for what you expect from a borrower, whereas during servicing, that becomes much more difficult, and it does present an issue to a lot of servicers to confirm that. But again, it's it's not dying down at all. This has been an issue that's been going on for at least a year and a half. And more recently, we've actually seen this more and more being applied to flood, which is somewhat unusual because on hazard side, we've seen that for a while. But now it seems like it's really spilling into flood, and the auditors are really looking to see, how do you know how much it would be to repair that property and bring it back to the condition prior to the loss. So again, something to watch out for. If you haven't already dealt with it, it's definitely coming. All right, we can go to the next slide. All right, so what does that mean? Again, federal oversight weakening, state and GST enforcement is rising, but the bottom line is compliance obligations still remain. In fact, Reg X, it's still out there. It's still a rule. States have their own rules. I believe that in the last 9 months, we actually have seen more complexity in compliance obligations, rather than lessening of compliance obligations due to the weakening role of the CFPB. So it's going to be interesting to see what happens next few years. But if the trend continues, our concern is that you're going to see a lot of different requirements come from different states, and of course, each state has their own specific, flavor of how they do things. So it adds more complexity. So it's, again, more important than ever probably to have a good compliance management system. And that includes having actually written policies and procedures. So sometimes, those things just get put off to the side and they might not be reviewed on an annual basis. Strongly encouraged to review your policies and procedures. You are going to be required to provide copies to the auditor. We've seen that even on the state side, or when the states are auditing, where they do require lender-placed insurance procedures to be examined. And then consistency between your policies and procedures. Again, when you update one, make sure you have the flow down of change management. And then I also want to point out to monitor complaint trends, because as much as we don't love getting complaints, it's one of those things where it's a very valuable resource that you have, and use that in order to build up your program and figure out, things where you might be at risk. Then proper documentation, make sure that you have copies of those letters that you're sending to the borrower. Again, RESPA is still in play. States are enforcing it. They're going to look for copies of those letters, and monitor state level developments, and absolutely prepare for multi-state exams because they're coming. And then finally, work with your lender-placed insurance provider, because we probably have seen it all. We see a lot of this stuff, and we're a good resource to try to help you work through it. So, all right, thanks. Back to you, Mike.
Thank you, Malgosia. Very timely. So a couple things I just kind of want to jump into here, and I'm using the full year of 2024. We'll update it through end of 2025 here. But what's interesting about this, and I think about this quite often, and I'm sure most insurance folks have some sort of debate or discussion, even in their personal lives, about these impacts and why it means to us. And anywhere across the United States, we're seeing an increase, which we'll get to in a second, on homeowners coverage, your auto coverage, et cetera. But I thought this was always an interesting graph to kind of just put some perspective around what's really caused this. So if we look at the perils by losses in 2024, most people would assume it's your big hurricanes, your big fires in California that create a lot of this. And the story is often told quite differently. 2024 is even a little bit more. But if you look at the biggest population, it's severe convective storms. So this is your wind, hail, losses, your other events not associated to some of those bigger headline risk type events like your hurricanes. So I say this because nobody is immune to any of these losses. I don't care where you're at in the country. We are experiencing losses on all magnitudes, big and small. But when you add it all up, the story is told a little bit differently than you might think. So I always find this kind of a valuable snapshot of actually the reality of losses. We can go on to the next one, Joel. And these next two slides are very interesting and telling. And you think of your own personal insurance purchases over the last few years. A lot of people have significantly seen this drastic change, and others might have not noticed as much. But when you look at the reality of it, it's pretty significant. So this snapshot's 19 through, at the time, year to date, 2024. But what I want to call out is if you look at that aggregated 19 through year-to-date 2024, 5 of the top 10 homeowners insurance carriers has increased rates by over 50%. And you can just look at 23 to 24 in the red circle there, the significant increases. And it tells a pretty detailed story of where we're at, and it goes back to the original point of coverage availability. So they might be able to find coverage, a homeowner, but how affordable is it? And I think kind of the two go hand in hand. We see oftentimes now where people say the availability, but it's really the affordability, and it's increased so much. You tell the story about grandma who's been in her home in Florida for 25 years, bought the house at $200,000. Well, and the insurance was $500 a year. Fast forward 25 years now, insurance is $10,000 a year now, but the property value has also increased so significantly. So you're insuring more of a home at a higher rate. And this is where it becomes kind of the affordability issue that we see potentially coming. There's a lot of discussions around a lot of this. What will happen is kind of an unknown when we jokingly talk about the crystal ball or the 8-ball and what the outlook might be. And it's still difficult to predict, but you see the impact just at these carrier levels. Then the next slide, Joel, digs into the top 10 states of increase. So again, I talked about no one's immune. If you look at the top states, they're all kind of obvious. You're California, Texas, Florida. But then you get into New York, Pennsylvania, Illinois, Ohio, Georgia, and Michigan are all on this list. And you see the significant increases. Again, these top states, cumulative rate changes over 50% over that 6-year period. And then you look at 23, 24, again, massive increases. So from what I have been able to distill, we're still seeing increases, not to this magnitude, but it is still ticking up. Joel talked about the commercial market. This is more of your homeowners market. So we are seeing that it's still moving in the wrong direction. However, it does seem to be coming down in a percentage basis, at least into 2025 so far. Okay, Joel? So next, I always like to kind of give some general principles around insurance tracking. And again, this is regardless of your smaller community banks that might be doing this tracking and monitoring of policies in-house or outsourcing it to a third party. And historically, there's been 2 methods of this. One is what we refer to as a negative tracking, and that was more of a reactive program. So basically, you would issue a loan, collect coverage at time of close, and you wouldn't react until you received a cancel or a non-pay or some event that triggered something at some point. You weren't actively tracking and monitoring the coverage. I think that for the most part has been set aside. And we use the term full tracking. Again, whether you're monitoring that in-house or through a third party where you're actively monitoring it, meaning every year you're looking for a new policy, whether that's escrowed or non-escrowed. Escrowed's obviously a little bit more important in the way of obtaining a policy so it can be paid to that appropriate carrier. Next slide, please. So I think it's always interesting to talk about the principles because I think some of these get forgot in the process. And to Malgosha's points around policies and procedures, sometimes this stuff matters. And one of the ones I always initially talk about is the mortgagee clause. And it's one of those things that if you don't do right, it can have a lot of negative downstream impact. So if your mortgagee clause is not correct, maybe you have multiple locations, maybe there was an acquisition of another bank or servicer, and things weren't appropriately updated, or you don't have a procedure or process to capture that in real time as you obtain or find that there's a misrepresented mortgagee clause. Because if you're not getting those policies, then ultimately you might believe that there's no insurance. You might start sending these notices or making these phone calls. Now we've got an upset borrower. Their issues now turn into complaints, and nothing leads to anything positive when you don't get that basic thing right, which ties to your mail. How are you processing your mail? Do you have good OCR technology? Are you leveraging any AI availability? How do you manage the mail to make sure you're processing those documents in a timely manner? Sometimes that matters more on when you're in the lender-placed process and you receive a voluntary policy that you just didn't get prior to turn around and post that. And part of the reg is to refund that money into the escrow account within 15 days. So you need to make sure that the mail process is adequately quick, but also updating the right procedures and policies to make sure it flows back through. Electronic data, this can be as simple as EDI, right? So a lot of that is actually driven off the mortgagee clause, so another reason it's important. But obtaining as much insurance data as you can electronically will only speed up the process, both from the receipt of data, but also if you can disperse the escrow premiums back through the process. A tracking tool, whether again that's through a third party that's built and designed technology around this specifically, or if you're using just your loan servicing platform or some other tool that you might have built or leased, make sure you've got a good process to track those expiration dates. You're following up both pre-expiration and post-expiration, making sure the letters and notices are going on time. All those things are critical. Escrow. It's one of the key components to anything that we do, whether you're servicing it or you're outsourcing it yourself. Our responsibility is to disperse those payments so that the payments are made timely, so the policy is in force and there's not a lapse. There is a lot of talk now about, and some carriers are being far less forgiving on if you pay a policy post expiration, what they're willing to do on a backdate provision. Your lender place process. Are your letters going timely, especially around flood? Do they have the required CFPB language? Are you able to prove to an auditor or an examiner that the date they went? All these things are critical to passing or failing audits. Call center, I think this is one that probably gets overlooked a lot too. Insurance is a very difficult subject if you're not an expert in it to explain to a homeowner that just knows they need to buy insurance. So one is the education of your call center and being able to respond accordingly to a homeowner, but also the empathy and everything that goes behind the support, because I will tell you, and our head of call center folks will tell you, not many calls are pleasant into a insurance call center, right? Something had occurred that they're probably aggravated with and just want corrected. So to have the empathy and give the tools to those reps to be able to first call resolute, but also then actually drive the change that fixes the problem on behalf of the homeowner will significantly not only reduce the complaints, but it also is in that borrower experience kind of mantra to where when they do go to refi, when they do to go to get a home equity loan, you want that recapture ecosystem where you're now have built this incredible experience, whether it was a bad reason for them calling or not, and turned it into a positive. So I highlight that one. Please make sure that you're spending time with those folks. And then audit and controls, tying back to what Malgosia stated. Are you testing? How are you testing? How are you proving that? Are you able to provide the evidence? And then have it all documented. So again, sharing kind of what we believe are these principles that make the process stronger in the event somebody comes asking the questions, which they will. Next slide, please. Just check through. Back one, next. A couple other things and then a couple comments here. So there are some other coverages that I think all organizations should think about. One is which we refer to as blanket policies. So this can be on your second loans, junior liens, HELOCs. Coverage is maybe not in the first position where, including condos, both HO6 and the HOA master, both have benefits. While there is a cost to the financial institution to buy these, you do have the availability to purchase them to protect that loan type without all of the minutia of the insurance tracking. So something to consider with whoever you're working with on your lender-placed insurance. I'm sure they'd be able to advise you on what's available if you don't already have it. And the second is the mortgage E&O, or you might hear it called impairment. This is if you think of it as the umbrella that sits over all of loan servicing, everything from taxes to insurance to defaults, all of these things that could slip through the cracks. It is sometimes inexpensive policy, but it also then gives you some authority on selling and buying things some organizations and some of the GSEs require. So again, just another comment. And I want to get a couple comments. One of the things we talk about nowadays is there's no such thing anymore as a fixed mortgage, right? Your actual mortgage payment might be the same, but your T&I, your taxes and insurance have changed so much. This is the this is the epidemic that we're kind of now facing of, hey, my payment was $1,500 5 years ago. Now it's $2,500. I can't afford it on my Social Security check, or I can't afford it with my income. So I want to remind folks here that in this process, one of the most beneficial things that we could advise on is the education to the homeowner. That's both at closing of a loan, but anytime you can communicate that through the servicing process of what all of this means, and why it's important that they carry their own coverage, we think is a critical component to kind of helping shift the mindset of the homeowner of making this a critical component. They should be shopping it yearly. They should be looking for the best rates, the best terms, and then advising them on what those are. So the limits that are required and all the other things that are important to the servicing side. So I'll stop there, Joel, because I know we're really short on time here. So I'll pass it back to you.
Great. Thanks, Mike. Yeah, so just keeping an eye on the clock here, we'll now just touch on two more briefly significant risks that any financial institution, bank, non-bank lender have to think about. These are definitely board level concerns, board level enterprise risks for any institution. Cyber is just the topic these days, and technology risk that you just cannot beat to death. And while this is a 2024 Bank of New York community bank survey, it's really, I think, indicative of the whole FI space. And you can kind of see the smallest banks out there are this deep into their digital strategies and technology evolution. It's truly thematic across the space. 30% of community banks are looking at new services like Insta payments. 20%, I think this is probably low, are collaborating with fintechs. 90% are ready to implement digital transformations. 40% are looking at AI. Cybersecurity is the leading long-term concern over the next 5 years. So you get the picture. Really what we're seeing is financial institutions of all different stripes rebranding as technology companies. And so as we think about the cyber coverage, this is now very, very board level insurance discussion for any financial institution. And the product really is pretty young still. It only goes back 20 years. It got very broad very quickly, just as technology and digital transformation accelerated exponentially. In all honesty, the cyber insurance markets probably did not fully understand the breadth of coverage that they were initially offering through their first 15 to 20 years of existence. In 2017, you might remember NotPetya and WannaCry events, which were purely destructive attacks on companies. These were sort of the precursors to ransomware. In 2021, Accenture and Colonial Pipeline, those were like the big headline initial ransomware shutdown operations. Ransomware everywhere, ransomware as a service, ransomware as a business of attacking other businesses. And so, back in 2021 and 2022, the cyber market, similar to the commercial property market that we talked about earlier, went through their massive correction. The first really in the product and the market's existence. Loss ratios eclipsed way over 100%. Pricing could not keep up with losses. The market hardened. Everybody saw at least a 100% rate increase. Legacy markets were shedding their businesses, non-renewing, ransomware restriction, crazy 40-page applications, declining coverage if there was one bad answer in a cyber application. With this overcorrection, there was actually an overcorrection. Capital flowed right back into this product after a very short period of time, a very short, hard market. New insurers actually came into being to sort of take advantage of this short-lived hard market. Markets like Beasley, Bowhead, believe it or not, there was an insurance market, a cyber market called Cowbell. New insurtechs dedicated to cyber that started to bundle, they're actually technology platforms, proactive monitoring services with incident response services with insurance. So, insurtech solutions like Coalition that provide all of the technology, security, monitoring, and response. And then if they fail, they actually eat the losses as an insurance company. These sort of things came into the market, and very quickly in 2023, we started to see decreases and more competition. And fast forward to today, we really see it's quite unbelievable. A very competitive cyber insurance market again. Terms, conditions, pricing very, very favorable to financial institutions. Even CrowdStrike a year ago or so did not dent the market. By the way, that was not a security breach or a security incident. That was a push out of a system update by CrowdStrike, which triggered a Microsoft Windows crash, the blue screen of death. And the insurance markets, just as an anecdote, were fairly insulated from that event because most buyers of cyber insurance coverage at that point were not buying system failure coverage, something banks really do need to think about and make sure that and financial institutions and lenders need to be thinking about buying. And so, that is kind of the state of the cyber markets right now. Very competitive, a lot of capital, good time to be sort of investing in your cyber insurance program as a lender, because, we're just sort of waiting for that next big headlining event that could sort of tip things over, generate losses that create a correction in this market. I'm just going to because of time, just kind of move through this. So our last market that we're going to talk about is of course directors and officers liability. This is used to be the biggest, most prominent insurance purchase that any financial institution or bank bought. Now I would say cyber is right up there with D&O insurance. This is the product, of course, that's intended to protect your boards and your management for mismanaging your institutions, breaching fiduciary obligations to your shareholders. And again, this market at this point in time is very, very competitive. The last hard market for D&O insurance came in 2021 and 2022. There had been a steady uptick of security class actions. M&A objections were automatic on the announcement of any M&A activity. You might remember SPACs, the SPAC claims. All of this led to lots of losses and a correction in 2022. And that correction has held. It's a pretty balanced D&O market right now, still fairly competitive. On the back of that correction, you did have more capital flow to the D&O markets, and you had the creation of new insurers dedicated to writing financial lines and D&O insurance. Vantage, Falcon, Westfield, legacy players like Allianz and Everest allocated more capital to the financial lines and the D&O markets, and that market has really normalized. We're now in a very risk-on environment. SPACs are back, and M&A is back, and so an eye towards what and new crypto strategies. So an eye to how sustainable is this stabilized market? Will sort of the risk on paradigm that we're in, will this start to create more litigation? Will this turn the market at some point? But for now, very competitive. Good time to be buying up and investing in this program too, if you are a financial institution. And so just looking at the time, we are close to time now. And yeah, we are close to time. So I want to just thank everybody. We have a QR code here. And if anyone would like to get in touch with any of us to further discuss, we'd love to continue the discussion with you all. So thank you.
Thank you, Joel. I want to pass things over to Mike and Magosia for some closing thoughts. And then I have a couple questions that I want to jump in. I know that we're at the end of almost at the end of our time. So Mike, Magosia.
Yeah, I'll be brief. It's still a challenging time. Good partnerships matter in financial institution space, mortgage servicing, lending, anyone across your vendors. Work with the right people that have your back and support you through all this, because it's a lot of change coming. So thank you, Elson. Magosia?
I just want to reiterate that, I think compliance has gotten more complex. I think you have more sources of where your regulatory findings could come from. So definitely work with your provider to try to mitigate that as much as possible. And they are a valuable resource.
And I want to jump into my first question, which is, where do you see the insurance market in the next few years?
Or maybe I'll take that.
Sure, good.
Yeah, like my crystal ball, as we sort of discussed right now, we're in a moment of time where really all of the major insurance markets that financial institutions, lenders, banks have to sort of contend with are favorable. They are flush with capital. They've all sort of corrected their most recent hard markets. That being so, it's a good time. Like recommendation is, again, now's the time to invest in your insurance programs while you can. I think we're all looking at the cyber markets and just with, the acceleration of digital strategies. Every day there's something new going on in terms of technology, digital assets, et cetera. And there's a lot of aggregation risk out there. And so if, was going to be a betting person, the cyber markets are the ones that we're most watching to see how long the super competitive nature of that market can sustain itself. So, I can't predict number of years or how long, but that's the one to watch in our opinion.
Perfect. And then I want to make sure that we touch on the CFPB piece before we leave. So I'm going to jump to that question. With the uncertainty around the CFPB, do you expect things to get easier or harder for financial institutions?
So yeah, definitely more difficult.
All
Yeah,
right.
more sources of failure.
Well, thank you so much for joining me today, Joel, Mike, Magosha. This has been a really interesting conversation. I know that webinar time goes by so fast, so I'm going to make sure that our audience has that QR code. And that is all the time that we have for today's webinar. Welcome to the Insurance Risk Era, insurance solutions that actually work. I want to thank our panelists, Joel, Mike, and Magosha, for joining us today. HousingWire will be sending a recording of this out to all registrants next week. So if you want to send this recording to anyone who missed any portions or rewatch anything, you'll be able to do so. Thank you so much for joining us today.
Thank you, everybody.